time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. I think you're going to do Snap-on, right? Is it Snap-on?
Snap-on. Yeah, not Snapchat.
Not Snapchat.
No.
Brendan's
disappointed
app.
now. Yeah,
I know, it's true.
We broke his heart with that one.
Almost.
All right,
talking about
it's my primary form of communication.
Just kidding. There
Snap.
you go. Yeah.
But
Snap-on,
Snap.
symbol SNA, not Snap, SNA. Yeah. On the New York Stock Exchange, it's a leading innovator, manufacturer, marketer of tools, equipment, diagnostics, repair information, and system solutions for professional users performing critical tasks in vehicle repair, aerospace, the military, natural resources, and manufacturing. The stock is currently trading at about $296, up about 51% over the past year with a dividend yield of 2.2%. So let's go through a quick rundown of their last quarter. Q1 2023. Net sales increased about 7.8% to $1.2 billion, which was an organic growth rate of 10.2%. That had offset by foreign exchange translation. You saw effectively every U.S. company have that same issue over the past year as the U.S. dollar's been remained strong. So you've been seeing that across the board if they have international operations. Gross profit increased to $509 million with a gross margin improvement of 110 basis points to 49.8%. Operating margin before the financial services segment was up 170 basis points to 22%. And including the financial services, it was up 80%. Or 80 basis points, I should say, to 25.6%, resulting in operating earnings growth of 11.1%, $326 million. Diluted EPS was up 15% to $4.60 a share. Overall, strong quarter of earnings. And as CEO Nick Pinchuk said in the conference call, Snap-on's momentum has really been unbroken and vibrant, highlighting really that the concerns which many people have having, including myself, about recession really impacting this company has been not realized in the last quarter. Now, shifting to the balance sheet quickly, the company has net debt of $413 million, resulting in a net debt EBITDA of about 0.3 times, meaning leverage is just generally not a concern at this time, especially given the strong cash flows that the company has. And its long-term debt is fixed at relatively low rates. With the next refinancing, if they needed to, they could just pay it off with cash at this point if they wanted to, not being until 2027, with the other two notes being 2048 and 2050. So generally speaking, really strong balance sheet, no concerns there. But as the company does operating in consumer finances as well as contract financing, it's always really good to check in on the strength of the receivables, as they can just suddenly tank, and that really hits the company hard. Snap-on does have $2.3 billion in gross financial receivables outstanding, and delinquency rates across the board have been generally steady with minor fluctuations, which are expected quarter to quarter. But the net loss in relation to delinquency for extended credit was 2.46% for the portfolio, up 12 basis points compared to the same quarter last year, but that's still 45 basis points lower than the year end for 2019, so pre-pandemic levels. So if we really see credit conditions tighten, which many people are expecting, we could see that metric and delinquency rates rise quite a bit, but we haven't seen that this time, but that is something you really constantly want to watch with a company like this. Now moving to valuations, the price to earnings is about 17 times, and price to cash flow is 15 times, not particularly cheap given its historic growth and prospective future growth, but it's not awful either. So our take, the company is really resilient and it's in an in-demand market at this time, but there will likely be headwinds in a recessionary scenario. It has a great balance sheet and consistent cash flow supporting dividend growth, and it's been doing share buybacks as well. But given the recent run-up in price over the past year, the room for stock price appreciation is a bit questionable. So I would say it's more of a hold at this time. You would really want to wait for a bit better valuations. It's not the worst time to buy if you're looking at a 3 to 5 year. But since there are potential headwinds in the near term with the credit tightening, and as well it is of course, a bit of a cyclical end market with autos, but it's not as cyclical as just straight auto manufacturers. There can be a bit of cyclicality in its earnings, but we aren't seeing that quite yet. So assuming really no deterioration in fundamentals, a bit cheaper valuation would be a nice entry point. And I'll open it up to you guys.
Awesome.
One thing I thought I did notice there is that the price to cash flow is more expensive than the price to earnings.
No. Yes, you are correct. Yeah, 17 than 20.
Yeah. So, I mean, that could be an issue, not necessarily, but an issue with earnings quality as well. Typically you would want to see the cash flow higher, not the cash flow valuation, but the cash flow higher than the earnings, which would result in the valuation to cash flow being lower. But that would be something that we would look into if we were interested enough in going to the next phase.
One thing that I'd like to say about Snap-on too is they kind of have an interesting business model from my understanding where a couple of my friends are mechanics, and essentially there will be a Snap-on truck that, drives to the Toyota dealership and, knocks on the mechanics doors and tries to essentially, sell the mechanics in the shop some tools. So it is kind of an interesting, rather than just placing their tools in a Canadian Tire or a PV Mart or whatever. The vendors will actually drive specifically to the mechanics or wherever the industrial workers are working and try to sell to them directly. But again, from my understanding, Snap-on tools generally are a little bit pricier. Now, I mean, you might get what you pay for. The quality might be better as well. But that's at least what I've heard from my mechanic friends, is that, they are generally pricier. A lot of the times when the vendors are coming to sell, they will, hit you with these installment payments for these tools that you can make. But it is kind of an interesting model where, again, it's not just, in the big box retailers, they're coming directly to you and a salesman is trying to sell them to you.
Yeah, when I was looking at the company, I was surprised their gross margin is just under 50%, which is quite high for this sort of company. So, I would not be surprised if you're seeing a premium compared to competitors there.
For sure.